I think we can go ahead and get started. Folks
Sure.
will continue rolling in. Yes.
Awesome. All right. Well, first off, thanks everybody for making some time right now in the afternoon. We're going to spend the next 25 to 30 minutes walking you through a brief presentation. We're going to save as much time as we can for questions at the end, but please don't hesitate to interrupt as we go through. This is our first time walking through this with the group. It's honestly really helpful for us to get any feedback whatsoever. And we'll send a copy of the deck to you after we conclude, and also always available for one-on-one questions offline as well. If you don't mind flipping the slide. If you're on this call, you probably already know the answer to this. What is Juno? Nikhil and I started Juno about 4 years ago to help our classmates save money on student loans, candidly to help ourselves also save money on student loans. Since then, we've been really fortunate to be able to grow that audience to over 100,000 people. And they come from MBA programs, law schools, engineering, medical, dental programs. Phase 1 of Juno has been all about helping people save money through group buying power. Phase 2 is all about helping people make more money. That's why we're here tonight. So thanks for being among the first people to whom we can introduce this. If you don't mind, go to the next slide. So really the theme of the conversation tonight is all about real estate. Whether you're interested in it now or you might be interested in it later, we thank you for joining and just learning more about how we're thinking through the industry. So why real estate? Well, we actually ended up spending a lot of time, Nikhil probably already spoke to a handful of folks on this call throughout the summer about their finances. And we identified a pretty common persona amongst our peers and amongst a lot of people who graduated from the Juno cohort. A lot of the time, it's folks who have an interest in exploring real estate investments, but have something that's standing in their way. That might be a really demanding full-time job that would prevent you from building your own direct real estate portfolio. You might have taken a look at easier investment options like REITs, public REITs, and just not liked the returns that are offered there. You might have come across some great private real estate syndications or deals, but they typically can have really high minimum check sizes. And as a result, a lot of people, including ourselves, find ourselves overexposed to stocks and sometimes crypto. We've taken that feedback and we've started executing on a real estate fund to make available first to Juno members. If you don't mind switching to the next slide, we're going to go through this in a lot more detail over the next couple of minutes. So no need to necessarily remember anything on this slide yet. But I'll walk you through at a very high level kind of what you're going to get throughout the end of the night. So we're going to spend a few minutes talking through our overall strategy, the types of assets that we're focused on, the types of tenants that we're focused on, and some things that we think can differentiate, reduce risk, and improve returns. Nicholas is going to walk you through a few minutes of how we think about selecting markets, the first one that we're going deep on, and how we're thinking about expanding beyond that. And then Nikhil is going to dive really deep into really what Fund 1 looks like, what's included in it, how long it's going to be open for, and all the details and assumptions that drive some of the figures you see on this slide right now. At a really high level, our goal is to do something relatively safe for this first fund and to try everything we can do to make it a resounding success. That means we're focused on investing, well, at a high level, trying to return 14 to 16% annualized returns, with the vast majority of that coming from quarterly cash dividends. So we're not banking on appreciation to drive the returns of this portfolio. We're also doing a lot of work to work with local housing authorities that will help us get recession-resistant tenants and rent that's guaranteed to get paid by the government. I'll walk through that in a bit more detail in a minute. And finally, we're focused on reducing minimum check sizes for this first fund so that we can get more people interested and excited about what it's like to invest in real estate. So if we flip over to the next slide, I was mentioning our strategy. At a really high level, we want to invest in areas of the market and asset classes that have very high cash flow. I talked about recession-resistant tenants. We'll go through that in detail in 2 slides, but what that means is there are government programs out there that we are already participating in, and we'll walk you through some examples. that pay us guaranteed rent on the first of the month. We're also focused on creating forced appreciation by buying some things that are a little bit run down and actually fixing them up. We've been doing that for a few months now, and there is a team on the ground locally in the first market that we are working in that's executing on that every day. And then finally, as I mentioned just before, we want to try to lower the minimum check size as much as possible. We think there's a hole in the market for, frankly, a lot of the people who are on this call who want to get more exposure to real estate without having to do a lot of the work themselves, but who also want to invest maybe smaller check sizes so that they can get started and exposed. If you don't mind switching to the next slide. So a lot of real estate pitch decks will show whatever IRR they want, but it's often driven by assumptions around equity appreciation. That's great. And in a lot of market environments, it's very true. We're focused on, honestly, something that's simpler. We're choosing single family homes to start. It's a really easy asset class to understand. We're going to rent them out for long term, and we're going to markets where there's really high rents versus the actual purchase price. This allows us to generate a lot of monthly cash flow from each of these properties. We've already done it with 6, and we're doing it with a couple of more, just with our own balance sheet, so that we can prove it and we can demonstrate it to you over time. Nikhil has been demonstrating some of this in some of the emails that he's been sending. What that means is that the majority of the return is going to come from these monthly cash flows. You don't have to believe as much about how we're going to get to that 14 to 16% IRR. And Nikhil will walk through a little bit more about what assumptions we have going into that at the end. Just going to flip through questions really quick. Yes, we will be sharing the webinar with folks on request, so please do reach out. If for any reason you need to drop off, we can send you the deck and send you everything else as well. We can also schedule some more time. All right, the second leg of the strategy I want to make sure to walk through is what I mean when I say recession-resistant tenants. So for those of you who might not know, Section 8 is a federal government housing assistance program. That means that for 2 million Americans every year, the federal government actually pays most of or all of their rent. Those rents are set at market value. So you're not taking a discount as a landlord to participate in the program. And they're paid automatically from a local housing authority to the property owner's bank account on the first of every month. So as we head into some uncertain economic times, you might be sitting here right now wondering, why am I talking about real estate at a time when no one knows what's going to happen for the next year? It's because we truly believe, and we're already demonstrating, that there are pockets of real estate investing that can thrive over the course of the next year and beyond. And we're tailoring everything towards making sure that we can reduce the risk associated with that. There are a lot of people who have common misconceptions about what the Section 8 housing program actually is and what the quality of the tenants are. We've talked to dozens of investors who've managed thousands of Section 8 tenants across hundreds of properties. And we firmly believe now that combining high quality tenant screening with property management, all of which we're doing in-house, gets rid of any concerns that could exist. And in fact, from people we've spoken to who invested a lot into this strategy, you often end up in a scenario where Section 8 tenants actually treat properties better than an average tenant would, because if they don't, there can be ramifications. They often end up staying longer than the average tenant would, so you have lower overall turnover costs and much lower vacancy costs. And there's actually an extremely long waiting list in a lot of different cities for the Section 8 program. So you have, and we're already working with a local housing authority, basically a large flow and bench of potential tenants who you can attract at any point in time. It's a great program. We honestly think not enough people participate in it, and we're gearing a lot of what we do towards honestly being a big player in it. The final leg of the strategy is about forced appreciation. Put simply, that just means we're buying homes that need a little bit of work, doing some light renovations and rehab, and we're able to buy them for lower costs on day one and create value through the work that we're putting in them. We you see on the slide right now is an example of one that we did just over the past 2 weeks. And we'll show you some more examples later in the deck of individual properties that we've already purchased, executed on the strategy, and will be rolling into the fund. All right, with that, I'm going to hand it off to Nicolas, who is going to walk through how we think about and select the markets that we want to invest in.
Thanks, Chris. So hello, everyone. I'm Nicolas. I'm going to walk you through our market selection strategy. Nico, if you can go to the next one. Thank you. So as Chris mentioned, we focus on 3 key aspects when we select a market. First of all, we want cash flow in markets. Second, we want recession-resistant tenants. And finally, we want a market with growth potential. So under the first one, we want to see a healthy rent-to-price ratio. We want to make sure rent is sufficiently high, that it can cover all ongoing costs of the property, and also provide a healthy cash flow for investors. Moreover, we want to see a positive trend on rent increases in the past years and reasons to believe that it will continue to increase in the coming years. Next, regarding recession-resistant tenants, we want to see a healthy Section 8 demand in the form of a wait list of Section 8 vouchers. And also, we want to make sure that the housing authority in charge of the area is responsive and willing to work with us. Finally, on growth potential, we want to make sure that the city we select has a stable population over a long period of time. And we want to see some employers moving into the city that will provide support and growth for rents and prices in the coming years. Finally, it's crucial that the area that we select is friendly for environment. It's a friendly environment for landlords, and also that it's deep enough that have enough inventory for us to execute our strategy. So without further ado, the market that we selected is the ring cities of Detroit. And I'll walk you through why it fits every one of the buckets. So on the first one, cash flow, I think this one it blows it out of the water. Actually, the rent to price ratio is 1.7 times the national average. That's more than enough cash flow to cover all its expenses and provide an additional cash like revenue stream for investors. Moreover, we have seen consistent rent growth over the past few years. In the past 3 years, rent growth was in average 6.8%. And in the past 5 years, and this is a yearly figure, over the past 5 years, it was an average 4.7%. It's worth noting that we are not banking on this rental appreciation for the future as we underwrite. We are assuming a more conservative estimate of 3%. Regarding recession-resistant tenants, there's a backlog of 25,000 Section 8 vouchers in the Macomb and Oakland County that are looking for housing. And we want to, and we know that we can provide, this will help us provide, fill our vacancies in a shortly manner. Also, no one, we actually flew out many times to Detroit, and we have spoken with this housing authority there, and they are very happy to work together with us to fill our vacancies, create a streamlined process, have effective inspection windows. So we are very confident on our strategy to execute with them. And finally, on growth potential, Warren, that is the largest city in the Detroit Green Cities area, grew last year 3%, and we think that part of that is due to many employers moving into the area, such as EV companies and battery factories moving in. So next slide, please, Miguel. We already started executing on this strategy, as Chris mentioned. We already bought 6 properties. We're in the process of buying plenty more. Cities that we bought these properties on are Warren, Centerline, and we're looking very closely to Dearborn, East Point, and others. The reason we go to these cities instead of going directly to Detroit is that we think they provide a stronger risk-reward ratio. If you go to Redfin or Zillow, you can see that you'll find plenty of properties in Detroit that are very cheaply priced, but the lower price point comes with problems like squatter or crime that we don't want to face in the properties that we select. So finally, over the next couple of slides, I'll walk you through a couple of properties that we already bought and the work that we did on them. The first property is a 3-bed, 1-bath located on Hub Avenue. This is it's a C+ area in Warren, Michigan. Honestly, the property was in great shape when we bought it. Just needed minor cosmetic fixes. It had a basement and a backyard. And we were able to get it for $95,000. We put in around $2,000, mainly light painting, fixing some closet doors, hand railing, and some appliances. And we actually just received our first check for this property from our tenant. That is $1,400. With these numbers, we're projecting an IRR of 21.8% and a cash-on-cash return of 17.3%. The next property is a little bit different. We actually had to put a little bit more work on it, as you will see. It's a 3-1 bedroom on Houston Avenue, also in Warren, Michigan. The property has still a backyard and a garage. It's a little bit bigger, which also means that the after repair value, the value of the property after we put all the money in, should be higher just because of the size of the lot where the property is located. And we were able to get it for $77,000. We put in around $15,000 of work. This requires like changing all the flooring, painting, electrical work. This one has a fuse box. It's a little bit outdated. And we also fixed some windows and all work around the house just to put it up to date and rent ready. For this one, it's conveying a rent of $1,450. We are actually putting on the market in the next few days, and we're expecting that a majority of that will come from Section 8. Finally, the IRR, it's 25%, around 25% for property, and a cash on cash of 20%. I'll leave it with Nikhil that will tell. Can you go to the next slide, Nikhil? That will speak about our offering.
Awesome. Thank you so much, Nicholas and Chris, with a very strong introduction of our strategy, the market, and how those are lining up. And that kind of flows into what we are able to offer for you as an investment opportunity by pursuing that strategy in this fund. So the first thing I want to highlight is we're trying to create one of the most investor-friendly options there are to invest in real estate. And you'll see this as a theme throughout the fund offering. We're offering an 8% preferred return. What this means is before Juno gets to participate in the returns from the fund, investors will be given 8% annually non-compounded. Right. So for example, if you're making $100,000 investment and the fund is operational over 5 years, $40,000 plus the initial capital of $100,000, $140,000 is going to come back to you before Juno sees any profit sharing from the returns. Okay. As Chris and Nicholas have outlined in some of the examples, we are far surpassing this, but the projected cash on cash return at the fund level is 10% to 12%. Of course, we hope to beat that. Similarly, on the projected IRR basis, once you take into account the debt pay down and the small amount of appreciation that we are hoping for, then the IRR comes in at 14% to 16%. What I will add is these returns are tax advantaged compared to sort of other returns you might get through your W-2 income and things like that. So there's some additional benefit there that's not reflected in any of these numbers. The minimum investment is $10,000. However, we do have 25 slots open for members who want to invest between $5,000 and $10,000. That's on a first come, first served basis. I believe a number of these slots have already been reserved. So if you want to invest between $5,000 and $10,000, I highly encourage you to make a soft commitment by emailing us and letting us know that, hey, I want to reserve one of those slots for myself. Okay. And the way the fee structure is structured is there's a 3% acquisition fee at the acquisition of each property, as well as a 30% promote. So that means after that 8% preferred return, Juno will participate in 30% of returns on top of that. So just as an example, let's say there was an 18% return, the first 8% directly comes back to investors. From the next 10%, another 7% goes back to investors, and Juno would get sort of the 3% equivalent. Okay. So that's the way the fee is structured. Okay. Now, whenever you see returns, I always ask the question, like, what are the assumptions underneath it, right? Are they reasonable? Are they conservative? We have to have that. So let's talk about that for a second. Financing, I saw there was a question about that in the chat. I didn't answer it there because I thought I'd touch on it here. We're assuming up to 70% LTV. We've been offered that from lenders. We don't expect any reason we can't close on that all the time. We are seeing rates increase in the market environment, right? I think everyone's hearing the news and seeing that on a regular basis. For the duration over which we expect to deploy this fund, we believe we'll be able to deploy it at a 7.5% fixed interest rate. We do have sensitivity studies against this, the interest rates changing, and we're also prepared to adjust, how much we're offering for the properties based on scenarios where, interest rates increase rapidly in an unexpected fashion over the next few months. Okay. Rent. So like, has been mentioned already, the historical rental appreciation in these areas has been very strong, above, 4.7%, but our go forward assumption is 3%, right? And this is especially conservative on the rent side. On the property value side, similarly, the historical property value appreciation in these neighborhoods has been 7%, and then our go forward assumption is 3%. Right, that's taking into account sort of the environment we are in, as well as our thesis on the market. Finally, on the operations side, I'd say the maintenance one probably stands out the most. 10% of rent is a pretty significant maintenance budget on these homes, especially when they are recently renovated. Right. So, for example, there's a property where we're replacing a roof, replacing a furnace. Those are like the two largest expenses you can have on these houses. If those are brand new, it's really hard to see you get anywhere close to that number. But we don't mess with it. We factor that in to make sure that the cash on cash returns that we want to deliver for you come in, right? So those quarterly distributions hit the mark. Property management, we are vertically integrating. So, we sort of already know exactly what we're going to charge the fund for that. You get a little bit of an edge over here because most of the times when property management is outsourced, it's outsourced to someone who has multiple customers, right? And they have multiple priorities. Now we are getting, we'll talk about the team a little bit later, but here we have the added advantage of a vertically integrated property management team, yet the same costs that you would have with a third party. Okay, so what does it look like if this sounds interesting to you, all right? From a capital raising perspective, we're waiting on some legal paperwork to get done. As soon as that's done, next 10-15 days, we'll open up the fund, and then through Jan 30th, there'll be sort of an opportunity to invest in the fund, right? As Nicholas has already mentioned, we've started deploying the capital already, even before we've raised it. The reason for this is, the reason we are able to do this is we've basically put our own balance sheet to deploy it, and then we'll backfill it with the capital that's being raised. By March 30th, we expect to have all of the homes acquired. There might be a little bit of renovation and stabilization work that goes on for a month or two after that, but at the end of that, the properties should be stabilized, and it'll move on to sort of day-to-day property management at that point. For 5 to 7 years, we'll manage the properties, and then we'll exit them. We'll sell the properties out of the fund. One thing to note on the exit is, because we have this beautiful high cash flow strategy, we have the opportunity to time our exit a little bit better than a lot of other funds, right? Oftentimes, if you're waiting for a certain value, but you're not seeing a lot of dividends until you get that value, it's harder to wait, as opposed to by the time year 5 rolls around, if you're seeing 14-15% cash on cash returns, you might not, honestly, some people might want us to wait as opposed to exit the investment. So yeah, that's the plan in terms of a timeline. Okay. I wanted to highlight some of the value of being in the beta fund, right? The fees are, well below what market. We've incentive aligned this as much as we can, essentially making sure that we are making money when you're making money, right? And when you're making good money. So we already discussed the preferred return and the 70-30 split that happens after that. As you can see, the only other real fee here is the acquisition fee, right? At acquisition of a particular property. Otherwise, we're not charging financing fees, disposition fees, asset management fees. Chris and I are considering putting some loan guarantees. We're not charging any guarantees. It's very common when you do these forced appreciation strategies to see 5-10% renovation management fees. Nothing like that is being baked in here. So there's acquisition fee, and then you get a preferred return, and then we participate in the profits above that, right? So we are really incentivized to make sure the IRR is very strong on these investments. And what does that look like? So of course, this is a portfolio. This is very different from if you're buying one house, it's very easy to lay this out. This depends on a lot of factors, but this is what we hope to see, right? We just took an example investment here of $10,000. That's the sort of default minimum investment amount. What we expect for that is a 12% cash on cash the first year. That cash on cash continues to grow each year, and then on exit, sort of all the capital and then some coming back, along with that 13,000 includes some of the cash on cash for year 5 as well. Okay, and all of that amounts to 16% IRR. So like you can see, in the very early years, you're starting to see a very strong component of the return come from the cash on cash, thereby reducing your risk in realizing that return. Okay. Also wanted to show this sensitivity, like what if, right? I think there was a question over here, like, oh, what, in this environment, is it reasonable to expect rental growth? Let's say you don't expect rental growth, and 5 years from now, you're still renting at the same value, right? You're seeing, you can sort of follow the column to see, or follow that row to see what the returns could look like, right? Similarly, property appreciation. If you look at the sensitivity, you do pretty well even in a not so great real estate environment, because you're working on, you're sort of at the point of acquisition, because of that price to rent ratio that you're leaning in on, you're baking in a lot of your profits. Okay. There are, I want to cover upside opportunities. So none of this is something we are baking into our models right now. So the 14 to 16%, the cash on cash, none of this opportunities here listed on this sheet is something we're baking into the model, but we are going to continue to pursue it. For example, let's say the Houston property, we bought it at 77K, we put in 15K of work into it, we're all into it at 92K. If we can get it appraised for 120, 125, we can pull out all our cash and then sell and use that cash to buy more properties, right? And the initial investment is still a cash flowing investment. There is, we are seeing some properties, duplexes and triplexes in the area that can offer a slightly better price to rent ratio, especially under, in comparison to single family homes. So that's something we're looking at. And then 2 bedroom to 3 bedrooms, it's another one of these forced appreciation plays where you buy a 2-bedroom, it's got an extra living room, right? You convert that into a bedroom, and now by spending $3,000 or $4,000, you increase the property value by $20,000 or $25,000, right? On the flip side, we have risks, right? I think someone in the chat brought up default and eviction risk. Certainly, that exists. We've spoken about our Section 8 strategy, and we can talk a little bit more about our tenant screening criteria into what we're doing to reduce this risk, but that risk certainly exists. Exit risk, once again, by being heavy on the cash flow returns, we do have some flexibility in when we exit the investment while maintaining or even enhancing the IRR. But if that whole period of time is just a downturn in the market, there is exit risk. Vacancy risk, similarly, we've diversified away from this or managed this risk considerably by having vertically integrated property management, a person whose sole job is to make sure our properties are performing well, as opposed to someone who's thinking of multiple customers. And maintenance risk, stuff happens. So hopefully on a portfolio basis, we've diversified away this risk with a number of properties. But if for some reason we have a concentration of problems in our properties, then it can go over budget. And then interest rate risk, right? If we see rates go beyond our projections, then that can bite into the profitability of the fund. Okay. Any questions so far that I haven't addressed? What is the risk of rents going down? Yep, we can talk about that, Jacob. How did the market do in the last recession? Great questions. Okay. Team-wise, Chris and Nicholas are heading up acquisitions. Chris has led the negotiations for $500 million plus of Juno's student loans, many of which folks on this call have benefited from. He has personally invested in industrial real estate in Colorado, and of course graduated from Harvard alongside myself. Nicholas has a IB background, also been closely involved in many of our negotiations, and is honestly, seeing him in action is a lot of fun. Very great negotiator. I've been focused lately on the operations side, have some experience doing that in the US, self-managing 10 properties here outside of Boston, have some investments in various properties, some including this residential and other properties. And I also come from a real estate family per se. My dad has been developing all kinds of stuff, from private airports to commercial buildings to residential complexes, whatnot. Diego is heading our operations at the moment, working with the vendors, working with the contractors, working with the local property management involved in that selection process, and really creating a very robust, disciplined process for everything we do, and bringing tech into it to make it more efficient. We recently hired a property manager local to Detroit, Detroit native. They have experience managing several hundred units, both multifamily and single family in the area. They have experience with Section 8, which is amazing. And they're just a phenomenal, from a customer, like a tenant interaction standpoint, I can just tell now that they're going to be phenomenal. So they'll be joining the team on November 8th, and we're excited to have her on board. I also wanted to highlight, we're supported by a ton of advisors. We're actually very fortunate to have so many, amazing real estate professionals in our advisory network. Wanted to also highlight Pete Flint, who, co-founder and former CEO of Trulia, sold to Zillow for like $1 billion, being our lead investor in the platform, just not to mix it up with the fund, but in the company we are building. So with that, we will switch to focusing on the questions. Nicholas, do you want to talk about the financing environment and how we'll manage to that?
Yes, for sure. So definitely we are planning to finance our properties in the short term, right? Like as you saw in the timeline that Nikhil mentioned, in the next like 4 or 5 months, we should be fully deployed and with the properties finance. So some like we don't we're not exposed to that, and we will finance to rates that will be fixed at least for the 5 years or 7 years that this fund is going to be live. So if we lock up rates that match our projections, we will be able, to meet our expectations there. The only thing that I'll add is that we baked in some conservatism into the model. I'm working directly with lenders local lenders in the area that still have favorable pricing. So far we have been able to manage that risk, but definitely something that we are monitoring closely.
Awesome. The next question we have here is, can you share what market conditions impact the rent to price ratio? In theory, I expect rents to primarily be a function of home price. Chris, do you want to take that, or should I take a stab at it?
Chris, you're on mute.
Whoops, sorry. I'm trying to find the question again exactly.
Why does rent to price ratio differ sort of market by market as opposed to
Got
just
it.
based on house price? Yeah.
Yeah, it's a great question. The rent to price ratio, if you think of it from a total return perspective, if you were investing in real estate as an asset class, you'd have some benchmark for the minimum return that you'd want to see. That return is either going to be driven by increases in the equity value of what you're investing in, or from the cash flow that property generates, or some combination of those two. So you end up with big disparities where LA and New York and Boston and SF have returns that are driven almost entirely from equity appreciation and just a little bit from the cash flow, if at all. And a lot of other markets where the equity appreciation should be expected to be lower, but that the cash flow will actually return a majority of what you need. So honestly, we have no idea what's going to happen with the real estate market over the next couple of years, but we do believe that investing in recession-resistant, high cash flow assets is the way to go, and that's why we're putting our money there right now. And so this market is just one where we actually do see some supporting evidence for continued equity appreciation combined with great cash flow, but we're going to underwrite everything we do to relatively conservative numbers around both, and manage the risk of the downside above all.
The other thing I'll add is just sort of demographics of the area make a difference as well, right? Like even within a market, you sort of study sub-markets, and there'll be wide variety. For example, Ferndale, for example, is another ring city of Detroit, and we're not assuming we're going to buy anything over there because sort of the desirability of that neighborhood, a lot of Airbnb activity has driven up the prices of those homes to the point where but the rental demand is not as strong, right? So it's a little bit it does depend a little bit on the demographics on the area as well. Just curious, how did the market do during the last recession or a period of financial hardship? Nicholas, you want to take this one? How did the Warren market and ring cities of Detroit do during 2008, etc.?
Yeah, I think that. Go for it. Well,
sure.
I just. Okay, Chris, go
ahead. So the Great Recession hit Detroit in general very hard. You had GM go bankrupt. A lot of things happened. The ring cities around it much less hard in general. And so when people talk about Detroit, there's often I'd say like a lot of negative connotations to investing there. It's a large area, and we're certainly looking at the pockets that have performed much better over time. And we can actually share with you what the We have the backup data for what the Section 8 rents, basically the program that we're primarily relying on, looked like from 2000 all the way to this year. And even during the Great Recession, up until now, you still had an average annualized increase of well above 3%. But we can certainly share that. Yeah.
I'll just add that in that specific year, the rental increase was of 1.5%. So it did actually decrease the rental demand or the rental price. It increased, but by a lower amount.
Got it. I just realized the chat is very active.
Do you mind flipping to slide 23? Because it seems like there's just a handful of questions about that.
Yep. Yes, I can walk through this slide. So this is essentially what we are expecting investors to experience, right? So what we want to see is, on year zero, like January 30th, for example, right? You would wire transfer $10,000 into the fund, and then over the first year, you would receive quarterly distributions, right? And those quarterly distributions would total $1,203. And how that would come about is we would receive sort of gross rents minus sort of vacancy assumptions, etc. We would receive about 3,054 minus the 3,000 includes reduction for sort of insurance expenses, the maintenance budget, the property management expenses, the real estate taxes. So after you subtract all of that, we have a sort of a profit, a fund level profit of 3,054. Then we'd pay the banks for any financing we've taken. Their 1,600. There'd be any fees and expenses that need to be paid beyond that's not accounted for in the NOI. We would take that out, and then finally, $1,203 would be money that can be returned to investors, right? And that sort of continues for 4 years or 5 years, and at the end of year 5, this number is much larger because we sell the property, right? So when we sell the property, we sort of realize all the debt pay down and the appreciation, and that becomes sort of hard cash that we distribute back out to investors, and then that's kind of it, right? Then we hope that you ask us, hey, can I put this money back into the next fund? But for this fund, that would be it.
I think there's a question regarding renovations from Jacob.
The purchase price, but needing 15K, 10K. Can you talk about the analysis behind some of the dollars to improve property? How much can you expect to get back in upgraded rent, all things equal, or is it more about the exit value? Great question. It's really about both, right? Because some of the properties we are buying in a condition where you could not, well, maybe you could rent it, but you couldn't rent it to an attractive tenant, right? A tenant that you want in the condition that we are buying, right? So in that case, you could argue that it's a make or break situation to get it rented. And then certainly there's two values. One is if you can get it appraised at the right value, right? 3 months after you have it rented, so you can stabilize the property, demonstrate the rents to the bank, as well as show them photos of a beautifully renovated property and get it appraised. You can pull a lot of the money out and put it back into another property that you can buy. And then, of course, the exit value is also improved based on that. So there's a few advantages to putting the dollars in. In our base case modeling, we are not modeling the refinance, right? So yes, we are modeling the improved exit value because there's no way we would not put that. If we put $15,000 into a property, there's no way we would not increase the value. But we're not assuming the refinancing in our base model. That's just upside. We hope to get and blow past the returns we are modeling. I actually sent an example of this in one of my emails that I did with a personal investment before this fund. And I think the returns jumped to like 46% or something like that. So can be a pretty needle moving. Will we receive a breakdown of how our dividends were calculated each quarter? Yes, Ethan. One big thing we didn't highlight here is we are going for maximum transparency, right? What that means is we want to get to you property level financials, which roll up into quarterly distributions. I can't promise this on day one, right? But in the first 2-3 months, as we get through this, we'll make if you invested in other funds, you have never seen this level of transparency that we are planning to provide. So you should expect to see property level monthly, basically a P&L statement and how that flows into your dividends. Can we talk about funding cycle? Is it 10K upfront? Yes. So, this is not a very large fund. We're not breaking it out into sort of pieces or capital calls, anything like that. It's just sort of one round, 10K minimum upfront. If you get one of the first 25 spots, you can do 5 to 10K. And then, yeah, that's sort of just one capital call per se. And then won't take more money in year 2, year 3 if interest fund is closed. So we expect to have additional funds available to you, honestly, all the time, right? So if you have funds that you're looking to deploy, this particular fund that we're discussing today may be closed, but there will be another fund with, it may have the same thesis, it may have a different thesis, it may be in a different market we've identified. So there will be a lot of opportunities to invest in real estate through Juno, but this particular fund will be closed for investment. At that point, you're just receiving money. You're not giving money more into this one. I appreciate all the questions. Great questions. Making sure we did our homework. Okay. All right. Oh, there's a new Q&A. No, I think that we already got that one. Okay. All right, we'll hang out here for a few more minutes. Let us know if you have any other questions. Otherwise, it's important to watch for essentially, if you want, especially if you want one of those spots for the 5 to 10K, I would sort of strongly encourage shooting us a note and reserving one of those spots. If you're investing above 10K, you probably have a little bit more time to make a decision. Let us know, book a one-on-one call with us. Let us know any questions you have. Can you explain the difference between the cash on cash and the IRR? Absolutely. So the cash on cash is the returns you're getting from just holding on to the property, right? So once the properties are bought, you get rental income, and then you subtract, whatever expenses like the real estate taxes that you pay, the insurance company expenses, the interest that you pay to the bank, some of the debt you pay down with the bank. And after subtracting all those, there's some amount of money left, right? That divided by the initial investment is your cash on cash. So for example, on this slide right here, in year one, you're getting $1,200 when you invested $10,000. That means you're getting 12%, 1,203 divided by $10,000 back in year one. And that's your cash on cash. IRR is essentially taking into account this last, year 5 payout, right? So an IRR is after accounting for time value of money per se, what is your annual return? Nicholas, is it fair to say it's almost like the effective interest kind of thing over the 5-year duration?
Yeah.
Yes, Nicholas, you want to talk about your lenders?
Yes, so we work with many local lenders. Actually, we spoke with plenty. We're definitely going to use, and we're assuming our base case up to 70% financing of our properties. So we do have some preferred lenders. We are actually thinking about like financing properties very, very soon in the next couple of days. And the rates that we have been quoting, that they have been quoting us are around or below our expectations. So yeah, we're definitely have that covered. Let me know if that answers your question.
If you have other lenders you think we should talk to, let us know.
How big a fund are you looking to pull together? So for this particular fund, the setup is effectively like a friends and family situation. The fund is what's called a 506B fund, which generally means we have had to have some previous relationship before you can invest in this fund, right? So it's really like a Juno member fund. And some of our friends and families, and we are self-investing as well. So this fund is going to be approximately $1 million, right? If we open it up to right now, part of what we're doing right now is understanding the investor demand amongst our Juno member base, right? A lot of our members have student loans, not surprisingly. And they're choosing between paying down the student loans and investing in this, things like that. So depending on investor demand, we may open it up to outside folks. That might change a few things, but at the moment, it's more of a $1 million, almost like a benefit to Juno members kind of fund.
Yeah, I'd say like that's certainly the first fund. We have every intention of doing this in a much bigger way very, very quickly. So let's see a few other questions here. Who are other investors in the space? A lot of talk of big institutional investors picking up residential properties. There are massive REITs that pick up single family rentals all across the country. They very often will be focused on larger average door sizes, meaning right now, the kind of the part of the market we're playing in is, I'd say, very cheap per home acquired. And it's a little bit below the market that a lot of the larger investors play in. But larger investors will very often buy a portfolio of, say, 100 homes or 200 homes that look just like the one that we're building right now. So we're really just kind of trying to come in a little bit under that radar, set up all the processes and the operations in as automated and transparent a way as we can to prove that we can do this quickly and add lots of properties to the portfolio and build a more valuable portfolio in the process.
Nicholas, you want to tackle the question about appropriate level of leverage? Why not higher? Why not lower?
Yeah, so we are optimized. So why not higher? Like two things. First of all, like the market environment, right? Like there are not that many lenders that will lend, like 80+% LTV in today's environment, but also out of caution, right? We don't want to over-lever our properties. We are planning for a multitude of scenarios, and we want to make sure that the properties always have, enough cash flow to be comfortable with the level of leverage that we are taking. Why not lower? Just because of the high cash flow that these properties give, right? That's kind of like we even that the rates are high, we know the rates are high, the cash returns that these properties are giving, the rental to price, and all the implicit cap rate that these properties giving us, it's so high that we're able to cover the interest and way more, right? So I believe in this type of property, we're not taking that additional risk that you can maybe take in other properties that don't cash flow that much, but you are expecting a big payout at the day of selling. In this case, we are, paying the interest as we go. So I think that's why we landed in the 70%. LTV.
I'll add one thing to that, which is right now we're starting with getting debt from local banks and credit unions. Once you kind of hit $5, $10, and $20 million thresholds for how much debt you need for the portfolios you're buying, you start to unlock access to, in many cases, cheaper capital. We were on the phone earlier today with a few different folks at credit shops with whom we might set up just larger debt facilities. And kind of over the longer run, it's possible to get debt facilities where you're paying the 10%, the 10-year treasury rate plus about 2% and locking that in fixed. So like a lot of larger funds right now would still be getting debt at 6.5%. And so we believe that if rates kind of stayed where they are today, just the process of growing allows you to unlock cheaper debt.
One note on the risk question, and Nicholas, I think the DSCR ratios we've often see banks underwrite to is like 1.1, 1.2, right? And we present these properties to them and they are grinning ear to ear because we're at like 1.6, right? It just blows out any banker's dream on DSCR. So we feel very comfortable with the risk level per se. Right. I think the other risk to mitigate is, from non-cash flow, just the other risk is just how much equity cushion you have, right, on an exit basis. I think that's really more the driving factor than the cash flow.
Just to clarify, the SCR is a debt coverage ratio, right? How much of our cash flow can cover that debt payments that we have to make monthly.
Awesome. Other questions? Really appreciate everyone engaging so actively. Jacob for driving some of this questioning. It's created a very engaging environment.
Yeah, and then honestly, if you have any feedback whatsoever, positive or negative, we'd sincerely appreciate it. We want to get better at this every time we do it. We really appreciate you trusting us with even an hour of your time right now. And it's even more valuable just to kind of hear what you're thinking, what maybe you wish you'd heard that you hadn't, and anything else we could provide more information on so that we can just keep doing better.
Diego, you want to talk about our tenant screening and listing strategy?
Yeah, sure. Great question. So basically, we're listing the properties everywhere that are available, like public listings, as well as, following up this Section 8 route that we were discussing previously. So like Nicolas said, we've developed a relationship with the local housing authorities. And so we're also listing the properties through them, which is a direct link to the waitlist that they have. So we're basically putting out there for any potential tenant to see it. and then we basically select what's the best rent for that specific property.
Yeah, just to expand that on a little bit more, right? You know, having the local support is incredibly important, right? Both from, for example, a lot of funds they operate without local agents in the area. We decided sort of to pay up for the local agent, primarily because we wanted that local knowledge in sort of block by block kind of knowledge in the areas we are investing. The team we've partnered with, they do about 500 homes each year, right? So they have, and they are investors themselves, of course, owning, you know, the lead investor, I think, owns about 35 properties in the area we're talking about. So very excited to have their support in getting that block by block level knowledge as we are buying the properties. And then, you know, from a tenant screening perspective, some of the unique things we're doing is like, you know, reviewing the current residents of the property, reviewing the current residents of the tenant to make sure that they're maintaining that property well, because that's probably the best indicator of how they'll maintain our property, as well as, you know, making sure landlord references are done on a reverse lookup basis. We find the property, we look up who the owners are, then source the property manager or speak to the owner directly and try to get the reference, as opposed to, you know, calling up a number on an application.
Yeah, which is, you know, to expand a little bit more on that, that's one of the reasons why we hired this full-time property manager locally, because she has a lot of experience, you know, screening these tenants before. And yeah, that will help us get a better tenant.
Awesome. All right. If you're interested, will there be a follow-up email to respond to with our interest? Yeah, I can reply to your note. Oh, Nicholas, can you post our email address in the chat? You can send a quick note if you want to make a soft commitment, but yes, there will be follow-up emails, both giving you the opportunity to make a soft commitment, and then once the legal work has been completed, there will be an opportunity to make a firm commitment and subscribe to the fund. We're still using the Juno email address for this right now, but we'll have a dedicated inbox. So, all right, I'm seeing a few participants drop off. Awesome. Once again, really, recording, yes, I think it's probably going to be sent out to everyone right after this, including folks who are not able to make it. And probably the deck will be included in that as well. So, yep. All right, with that, I think we'll wrap up. Thank you all for staying through all the way to the end and for a very engaging discussion. And yeah, we look forward to chatting more. All right, see you.
Thank you, everyone.
Thank you very much.